Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hello everybody, Ben Rains here. Today I'm here with top stock picks of the week for Zacks. Today I'm looking at Lamb Weston, which trades on the ticker LW. Lamb Weston is one of the largest suppliers of frozen potatoes in the world, selling a nearly endless array of potato-based offerings. And I know that sounds simple, but it really is. So they sell everything from classic fries to sweet potato, waffle fries, and really everything in between. They also sell potato chips, hash browns, mashed potatoes, along with some frozen vegetables. Lamb Weston sells those frozen potato products to restaurants and retailers all around the world. The company's offerings are rather impressive in terms of growth potential. They've grown really big besides the COVID downturn when obviously people weren't going to restaurants as much. But fries and potatoes are pretty staples in the U.S. and beyond, so it's a solid core business to be in. The company topped our Q1 FY 2023 estimates in early October, with revenue up 14% because it was able to raise its prices rather significantly. The company also saw its adjusted earnings soar. And so despite those large-scale macro setbacks that everyone's dealing with, Lamb Weston executives said they're on track to deliver on the higher end of their initial 2023 financial targets, so that's really impressive. So in terms of our Zacks estimates, we're calling for 15% revenue growth both this year and next, to go from about $4.1 billion to $5.4 billion. And this would follow 12% revenue growth last year. And then in terms of adjusted earnings, we're calling for another 46% earnings growth this year, and then 28% next year to get all the way up to $3.90 per share. And then the company's also seen its consensus earnings estimates climb for both this year and next to help it land a Zacks ranked number one strong buy at the moment. So anybody that's raising their earnings guidance is doing really well as the broader earnings outlook declines rather rapidly. In terms of its stock price, the stock has soared 45% in the past 12 months to crush that market downturn and outpace its industry's just 4% climb. This includes a nice, impressive 35% surge in the last 6 months alone to see it hit fresh highs rather recently. Despite that climb, it still trades below its pre-COVID peaks, and its Zacks average price target offers 9% upside to its current levels. And then in terms of longer-term performance, the stock has climbed 185% since it was spun off from Conagra back in the fall of 2016. It currently trades at about 24.9 times forward earnings, which is near its median since it went public and 22% below its highs. The company also pays a dividend that yields about 1.2% at the moment, and it repurchased nearly $30 million worth of its stock last quarter. And then 4 out of the 5 brokerage recommendations that Zacks has are strong buys with just one hold. So amid kind of the ongoing market uncertainty, it really favors going stable and boring sometimes, especially businesses that are proving to have big pricing power like Lamb Weston has. So right now it really appears that Lamb Weston might be a really good investment for the rest of 2022 and beyond. So that does it for me. And now I'm going to send it over to Kevin Cook.
Thanks, Ben. Kevin Cook here in my 10X hat. I just finished a weekend seminar with Grant Cardone and rushed back to the office. So my top pick is Okta, identity security. Okay, Okta is identity security, and this is important, in the age where everybody loses their password, and we're moving towards biometrics. How can we identify both customers and employees in better ways? So and Okta serves a lot of customers. They seem to be embedded in a lot of stacks. So 92% recommended by Gartner, over 16,000 customers, over 7,500 integrations. And I mean, that's the nature of the SaaS world right now, right? This is why, I always say to understand SaaS, just look at any Fortune 1000 company and they have over 100 different SaaS subscriptions because all these things integrate, and software is unlimited by time and space, so there can be infinite variations and different solutions, serve different functions that customers get sort of addicted to, and then they want it to integrate with something else. So here are the two main angles of attack for identity security from Okta, and that's customer identity and then workforce identity, as I mentioned earlier. I just want to show you some of their customers that really stand out here. You see some names: FedEx, S&P Global, Zoom, Takeda, some others. Oh, and just looking at the industries here is worthwhile too. So, retail, financial services, a lot of tech-heavy stuff. I'm looking at another resource here. I see they work with Box, they work with Slack, Workday, Zendesk, and DocuSign, and AWS. So Okta is well integrated. So let's take a look at the financials and why I think it's a buy, and then we'll take a look at the chart. So here it is, Zacks #1 rank right now. It is near 52-week lows. It fell off a cliff after earnings in September, late August, early September, and I think it's a buy here. $7.5 billion market cap. So let's go look at the sales, because we want to value this thing, as I like to do for all SaaS companies, see where it ranks in the price to sales ratio. So we're looking at the current fiscal year ends in January. So we're in fiscal 2023, but it ends in January. 40% revenue growth to $1.8 billion. $7.5 billion market cap. So if we look out to next year, projected $2.3 billion. The high, it's about 2.3, a little over 2.3 from 10 analysts. This is the consensus. That's going to be 27.6% growth, as you can see here, to 2.3 billion. And so valuation-wise, you're talking under 4 times sales, which is attractive for SaaS, right? SaaS was trading 20 times sales, and the bear market has wrecked things. The software is basically down 40% for the year, with a lot of companies down 80%. And so valuations, there's a lot of stuff still trading 10 times sales. So when you see something 3 or 4 times sales, it's trading well under peer valuations. Earnings wise, they are not profitable yet, and fighting back. It got clobbered this year, down 50%, but estimates have moved up steadily even since the September slide. So if we look here at the magnitude of moves, we've got, 90 days ago they were going to lose $1.10 for the year. That's come down to only 72 cents. Next year was projected they were going to lose 60 cents. Now they're going to lose 29 cents. So part of this year was about the beat they just had. Even though the stock sold off, they did beat minus 10 cents versus minus 30 consensus. So, but they even moved next year's estimates higher. So, it's all about the recurring revenue for these companies. So let's look at the chart real quick. Add this up here. Okay, so here's the earnings were September. Actually, they were August 31st. And then the next day, the stock gapped down 33.7%. The stock fell. Okay. And obviously, there's been some buyers nibbling here. I'd like to be a buyer nibbling here after last week's new 52-week lows at 44, just because I like the valuation and I like how they're embedded in all these security applications with all these Fortune 1000 enterprise companies. So that's why I like Okta. And I would, if you're looking at SaaS at all, last time I did Splunk, I love Splunk because it was trading at 3 times sales. And we got a 15% pop out of that a couple weeks ago. So this is where you want to nibble. If you like software at all, look for things that have had their price to sales ratios knocked down under 4 times. Thanks for watching this week's Top Stock Picks. And if you want to learn more about Zacks products, offers, and intense research for your investments, check out this week's promo. You can see the link right down below. Thanks for watching.